While you were filing your taxes last April, $21 trillion sat invisible in offshore accounts. That's more than the combined GDP of the United States and China. Where does it hide? Who put it there, and why can't anyone seem to stop it? The world's wealthiest individuals and corporations use a global network of tax havens to legally reduce their tax bills to nearly zero. These aren't backroom deals or illegal schemes. They're structured through law firms, accountants, and financial advisors in places like the Cayman Islands, Switzerland, and Luxembourg. This matters now because while governments struggle to fund healthcare, education, and infrastructure, an estimated 10% of global GDP sits offshore, untaxed. The gap between what's legal and what feels fair has never been wider. The modern offshore system didn't appear overnight. It grew from decisions made decades ago, each one opening a new door. In the 1920s, Switzerland passed banking secrecy laws that made it a crime to reveal client information. What started as protection for wealthy Europeans fleeing political instability became a blueprint. Banks realized that secrecy itself had value. After World War II, the City of London needed new revenue. Britain couldn't compete with Wall Street's scale, so it created something different. In the 1950s and 60s, London allowed banks to conduct dollar transactions outside US regulation. This euro-dollar market became the foundation of offshore finance. The Cayman Islands, a British territory, passed its first banking laws in 1966. Within 20 years, it registered more hedge funds than any place on Earth. Source: Cayman Islands Monetary Authority. Historical records. These weren't random choices. Britain's former colonies became financial satellites, offering low taxes and high secrecy while using the stability of British law. By the 1980s, corporations discovered they could shift profits through clever structures. A company might manufacture products in Vietnam, hold the trademark in Bermuda, and route sales through Ireland. Each step was legal. Together they created a maze. The 2008 financial crisis revealed how deeply offshore structures were woven into global banking. Lehman Brothers operated over 3,000 subsidiary entities, many in tax havens. Source: Bankruptcy Examiner Report 2010. When it collapsed, investigators struggled to untangle which entity owned what. In 2016, an anonymous leak exposed 11.5 million documents from Panamanian law firm Mossack Fonseca. The files showed how world leaders, celebrities, and criminals alike used the same offshore tools. The leak didn't reveal anything illegal necessarily. It revealed the system itself. More leaks followed. The Paradise Papers in 2017, the Pandora Papers in 2021. Each one showed the same pattern. Shell companies owned by other shell companies, trusts within trusts, nominees and lawyers whose names appeared on documents, while the real owners stayed invisible. The evidence for offshore wealth isn't speculative. It comes from economic analysis, leaked documents, and companies' own financial statements. Economists Gabriel Zucman and Thomas Piketty calculated that roughly 8% of the world's financial wealth sits offshore. They reached this number by studying discrepancies. When Switzerland reports holding foreign securities, but other countries don't report owning them, someone's not counting. That gap reveals hidden wealth. The leaked documents provide names and structures. They show how a tech billionaire might set up a trust in the Cook Islands, which owns a company in Malta, which holds shares in a Delaware LLC, which actually owns the real estate. Each layer is legal. Each layer adds opacity. Corporate filings tell another story. US multinationals reported holding $2.6 trillion in permanently reinvested foreign earnings before tax law changed in 2017. Much of that sat in Irish and Dutch, subsidiaries that existed mainly on paper. Google's double Irish with a Dutch sandwich structure legally routed billions through entities with minimal staff. Tax haven defenders argue these jurisdictions offer legitimate services: privacy protection, asset diversification, political stability for people from unstable regions. These arguments aren't entirely wrong, but they don't explain why so much money needs so much secrecy. The OECD estimated that governments lose $100 to $240 billion annually to corporate profit shifting. That's conservative. It doesn't count individual tax evasion, which is harder to measure. Not everyone agrees on the problem or the solution. Tax haven jurisdictions argue they're playing by the rules that richer countries wrote. The Cayman Islands points out that it has no income tax because it never did, not as an evasion scheme. Luxembourg argues it offers legal certainty and legitimate financial services. They're not wrong about the legality. Some economists suggest offshore wealth isn't hidden, just inconveniently located. If a billionaire's foundation holds assets in a tax-exempt trust, is that evasion or estate planning? The line depends on who you ask. There are also gaps in what we know. Leaked documents reveal specific cases, but not the full picture. Art stored in freeports, gold in vaults, real estate held through anonymous trusts. These don't show up in banking data. The estimates of hidden wealth could be too low or too high. We're measuring shadows. Some defenders of the current system argue that high taxes drive this behavior, not loopholes. If countries lowered their rates, they claim, the incentive to hide wealth would disappear. Others counter that some jurisdictions charge zero tax, making competition impossible. The debate gets complicated around legitimate uses. Multinational companies do operate globally. They do need efficient ways to move money. They do face different tax systems. Somewhere in there, legal tax planning becomes aggressive, avoidance becomes, in some cases, evasion. But the system makes it hard to tell where one ends and another begins. While the mechanisms are abstract, the effects are concrete. When wealthy individuals and corporations pay minimal tax, governments have three choices: cut services, raise taxes on those who can't avoid them, or borrow money and push costs to the next generation. All three happen. In the UK, austerity measures after 2010 reduced social services and local government funding. At the same time, leaked documents showed British territories facilitating billions in tax avoidance. The connection isn't direct, but it's hard to ignore. Schools closed while the tax gap widened. Healthcare workers and teachers pay tax on every paycheck through automatic withholding. They can't route their income through a Cayman trust. The system creates two realities: one for people paid in wages, another for people paid in capital gains, dividends, and offshore structures. This isn't about demonizing success. It's about fairness in funding shared infrastructure, the roads billionaires drive on, the courts that enforce their contracts, the universities that educated their employees. These cost money. To understand how offshore systems work, imagine a children's game of hide and seek, but the house keeps adding new rooms. Tax havens compete for business by offering secrecy, low rates, and legal structures that other places don't. It's regulatory arbitrage, shopping for the most favorable rules. Source: academic definition, international tax law. Companies aren't breaking laws, they're choosing which laws apply to them. Think of it like water flowing downhill. Money moves to where it's taxed least and protected most. Countries that try to tax it more find it flowing elsewhere. This creates a race to the bottom. Every country has an incentive to lower taxes to attract mobile capital. The result? Governments collect less overall. The system persists because everyone benefits a little, even as society loses a lot. Lawyers and accountants earn fees. Small jurisdictions gain revenue from registration fees. Banks profit from managing offshore accounts. The wealthy save on taxes. Only the abstract concept of government revenue loses, and that's everyone's problem and no one's responsibility. This matters beyond taxes. Offshore secrecy enables more than just tax avoidance. The same structures that hide legitimate wealth also hide corruption, money laundering, and sanctions evasion. When you build a system for privacy, you can't always control who uses it. Historically, governments have tried to push back. The U.S. Foreign Account Tax Compliance Act, FATCA, forces foreign banks to report American account holders. The OECD's Common Reporting Standard creates automatic exchange of tax information between countries. These help, but they're playing catch-up to a system decades ahead. The deeper question is philosophical. In a world of nation-states with borders, should money be borderless? Should tax policy be competitive or cooperative? Right now, we're in between. The old system of complete sovereignty is breaking down, but no clear alternative has replaced it. Here's what we know for certain. Trillions of dollars sit in offshore accounts. The structures are mostly legal. The leaks are real. The lost tax revenue is measurable if debated. What we don't know is whether political will exists to change it. Because changing this system requires countries to cooperate against their own short-term interests. So what happens next? The near future holds a few realistic possibilities. Countries continue tightening reporting requirements and information sharing. The OECD's global minimum corporate tax of 15%, agreed by 140 countries in 2021, gets implemented gradually. This won't end offshore finance, but it might slow profit shifting. The challenge: enforcement. Small jurisdictions can agree in principle while dragging implementation. As financial systems digitize, they become easier to track. Cryptocurrency tried to create new anonymity, but blockchain is actually transparent. Governments are developing central bank digital currencies that could make cross-border flows more visible. Privacy advocates warn this creates surveillance risks, but it might make offshore hiding harder. Each leak generates headlines, then fades. For real change, voters would need to prioritize this issue over others, and politicians would need to act against wealthy donors. Possible? Yes. Likely soon? History suggests no. The Panama Papers led to some prosecutions and reforms, but the system itself survived. The current equilibrium continues. Countries compete. Billionaires optimize. Leaks happen periodically. Reforms are announced but weakly enforced. This is the path of least resistance. Change requires coordination across competing nations, and that's genuinely difficult. The most likely outcome: a mix, gradual tightening of rules but creative adaptation by tax planners, more transparency, but new secrecy tools. The game continues, just on a slightly more level field. The offshore system exists not because it's secret, but because it's profitable enough for enough people that changing it requires fighting uphill. You can't hide $21 trillion forever, but apparently you can hide it long enough. If you want to understand how individual billionaires specifically use these structures, watch The Wealth Secrets of the Ultra-Rich, a case study analysis. It breaks down real examples with documents and receipts, source notes and disclaimer. This script draws on investigative journalism from ICIJ, academic research from economists including Zuckman and Piketty, government reports from the OECD and US Senate, and public statements from tax haven jurisdictions. Tax law is complex and varies by jurisdiction. Offshore structures have legal uses for asset protection and international business. This video focuses on tax avoidance implications. Information presented reflects reporting through late 2024 and may not include recent developments. No specific individual claims are made without public sourcing.